You know, in the business world, success can often feel like this big, unsolved mystery, right? You've got thousands of companies, billions of dollars, and just an absolute ocean of data. But what if I told you that hidden inside all that noise, there's a code, a clear signal that tells us exactly what drives a business forward? Well, today we're going full data detective. We're cracking open the case file on a massive industry to find the financial clues that lead straight to success.
So let's get right to it. This is the central mystery we're going to solve, and we're using a real-world academic study to do it. Forget about the hundreds of metrics and the confusing spreadsheets for a second. We are on the hunt for the two vital signs, the two critical clues that matter more than anything else. And the answer, well, it might just change the way you look at a company's performance. So, here's how we're going to crack this case. First, we'll set the scene for this high-stakes puzzle. Then, we'll open up our Data Detectives toolkit. We're going to line up the usual financial suspects, interrogate the data to crack the code, and then reveal the two most critical clues we find. And finally, we'll see how to build a model that can actually predict success. Let's get into it. Okay, so every investigation needs a location. Ours takes place in the massive, super fast-paced world of the ready-to-eat food industry. We're talking about everything from noodles and snacks to dairy products, you name it. It's a multi-billion-dollar world where the competition is absolutely fierce, and the financial stakes, they couldn't be any higher. And here is the core problem that basically every company in this industry faces. They are practically drowning in data. Seriously, they track dozens, sometimes hundreds of different financial metrics. But all of that is just noise unless you know which numbers are the real drivers of your sales. If you focus on the wrong thing, you're just wasting time and money. And that is the puzzle we are here to solve. All right, so to crack a case this big, you can't just show up with a magnifying glass, right? You need the right tools. We're using the power of statistics to find the patterns and the clues that are hidden deep down inside the numbers. This is where the real detective work begins. Now, our primary tool is something called multiple regression analysis. And hey, don't let that fancy name scare you off. Just think of it like this. If your final sales number is a cake, this tool helps you figure out which ingredients, the sugar, the flour, the eggs, had the biggest impact on how it tastes. It's a really powerful way to figure out what truly matters. So, in our investigation, there are basically two key players. On one side, you've got the outcome, the thing we're trying to understand, which is sales. That's what we call our dependent variable. And then on the other side, you've got all the potential clues, all the different financial metrics that might be driving those sales. These are our independent variables, and our job is to figure out which ones are the real culprits. All right, it is time to bring in the suspects. Based on real-world financial data, the researchers pulled together a lineup of the most likely factors that could be influencing sales. And here they are, our key suspects. We're looking at some of the usuals, right? Things like profit before tax and debt to equity. But the lineup also has some other interesting characters, like gross value added and even the ratio of exports to sales. Now here's what makes this case so solid. This data isn't just theory. It comes straight from the Reserve Bank of India. We're talking about real numbers from real companies. The suspects are officially in the interrogation room. Okay, so our suspects are lined up, our tools are ready, the analysis begins. The goal here is pretty simple. Find out which of these factors has the strongest, most undeniable link to sales. We're looking for the smoking gun in the data. And the first big break in the case comes from something called correlation analysis. This technique basically just measures how closely two things move together. So if one of our suspects always goes up whenever sales go up, well, that is a very, very strong clue. It doesn't prove it's the cause, but it tells us exactly where we need to focus our investigation. And then you get the aha moment. This quote, and this is pulled directly from the research paper, is basically the confession we've been looking for. After running all the numbers, the data pointed overwhelmingly to two specific suspects. Out of all the variables they looked at, these two had what the researchers called a profound effect on sales. So the investigation paid off. We managed to filter out all the noise, we dismissed the red herrings, and we have zeroed in on the two factors that matter more than all the rest. We've cracked the case. So here they are, the two critical clues to sales success. First, profit before tax. That one's pretty straightforward. And second, gross value added. Now that's a term you might not hear every day, but it is so important. It's basically the value of a company's output minus the cost of its raw materials. Think of it as the pure new wealth a company creates. These two numbers, they're the ones companies should be watching like a hawk. And the best part? The relationship isn't some complex, mysterious thing. It is a clear, straight line. The study's graphs literally show that as profits and value added go up, sales go right up along with them. It's a direct, powerful, and predictable link. Okay, so we've identified our culprits. Awesome. But for a good detective, that's only half the job. Now, we need to use this knowledge to predict the future. So, the researchers tested two different predictive models to see which one could forecast sales with the most accuracy. So let the model showdown begin. In one corner, we have the standard, tried-and-true multiple linear regression model. And in the other corner, we've got a more advanced contender called elastic net regression. The big question is, which one is the better crystal ball? Well, to pick a winner, we need a judge. And in data science, that judge is often the mean squared error, or MSE. All it is a score that tells you how far off a model's predictions are from the actual results. And just like in golf, the lower the score, the better. The model with the lowest MSE is our champion. And the results are in. As you can see right here, the standard multiple linear model scores an 11.17. Not bad, but the elastic net model, it comes in with a score of 10.18. Now that might not look like a huge gap, but believe me, in the world of forecasting, that is a clear and decisive victory. So, the verdict is final. The elastic net model is, without a doubt, the superior tool for this job. For any business in this industry that wants to predict its future performance based on its financials, this is the model that's going to give them the sharpest, most accurate picture of what's coming. So what's the ultimate takeaway from our whole investigation? Well, we've shown that if you use data as your guide, you can actually cut through all the complexity and find the two factors that truly matter. But that leaves us with an even bigger question. This particular case might be closed, but could this same data detective approach be used not just to predict sales, but to help businesses in any industry navigate the uncertainty of future economic crises? Now that's a mystery for another day.